Hello, this is Liz Higgins, an Ag Business Extension Specialist with the Cornell Cooperative Extension Eastern New York Commercial Hort Program. And in this episode of the 20-Minute Ag Manager, we're going to talk about income statements. So what are income statements? Income statements are documents that track the inflow and outflow of money from business activities over the course of a period of time, generally a year. Income statements are the financial records that would directly track the profitability of business activities on your farm. And the key terms we're going to talk about that we're going to define in a moment are income or revenue, expenses, and profit. So let's talk about income first. Revenue is money I earn through my business operations. Operating revenue is what I earn through my regular line of business. So let's just say I'm a peach farmer and I sell peaches. The money I make from my peach sales would be my operating revenue. Non-operating revenue is money that comes in through other sources. It's still part of my business. Let's say I get USDA cost share funding for some conservation practices. The revenue that comes in for those cost share payments, for wildlife habitat would be non-operating revenue. It's still part of my business, but it's not the core business function. A gain is a little bit different. That's just generally a way of capturing a one-time transaction. Say I have a tractor and its book value is $2,000 and I sell it for $4,000. That $2,000 would go into I have to capture that additional wealth somehow, and that would be as a gain. And so it would be income, but it would be from the sale of that piece of equipment for more than its book value at that point. And now let's talk about expenses. Expenses are the costs that I incur to generate revenue. You got to spend money to make money. So operating expenses are in my normal line of business, cost of goods sold. So if I'm a peach farmer, I've got to pay for labor to prune my peaches. I've got to pay for little baskets to put my peaches in. So that's all a cost of things that directly go into the peaches that I sell. Overhead expenses are allocated across my business sales and everything. So my mortgage for the farm, I grow peaches, but I also grow apricots, or I also may also do some timber. I've got overhead expenses for all of my land. I've got overhead expenses, taxes, administrative costs that I can't really allocate specifically to a specific line would be my overhead. And then we have non-operating expenses, and those are things like income tax payments that are not directly related to my business whatsoever, not necessarily related to my farm, but they're still an expense that I incur. Losses are very similar to gains. They're a one-time transaction. We had that example of the tractor with the $2,000 book value. Let's just say I decide I've got to get rid of it, and I put it on Craigslist and I sell it for $1,000. But it was in my accounting system as $2,000. I now would record that $1,000 as a loss. So because I sold it for less than I said its value was, or if somebody stole it, so the tractor's sitting out and somebody steals it, that loss would now that theft would be recorded as a loss. So I think we all understand profit. Profit is your income minus your expenses. It's that difference. Gross profit is the revenue from your sales minus the cost of sales. So we're just only looking at the sales of the peach minus the cost of the peach is my profit from peaches. Operating profit is my revenue minus my cost of sales minus my operating expenses. So that's when we talk about sort of like capturing both your variable cost, which is the cost of sales, and then your fixed costs, your overall overhead that you need to capture. My revenue minus those two things is my overall operating profit. And having that be positive is what allows me to stay in business. And then net income is all of my income minus all of my expenses is my net. So I take all my income and I take out all my expenses. My net income is that. So the three concepts are gross profit, which is your sales, direct sales minus variable costs, your operating profit, which is your revenue, minus the cost of sales minus operating expenses. So it's revenue minus fixed costs minus variable costs. And the net income is all of your income minus all of your expenses. So a lot of times, you'll ask, a bank will ask a farm to provide both a balance sheet and an income statement. And how are the two related? And they actually are directly related. If you remember back to the balance sheet, it's your assets are equal to liabilities plus owner equity. Well, at the end of an accounting period, the net income, all of your income minus all of your expenses, that net becomes a change it turns into equity, right? That growth in the business now is tracked as equity in the business. So you have more assets and you have more equity. And one way it's often talked about is retained earnings. It's the earnings that you generate from doing the business that year. So while we're on the topic of balance sheets and income statements, let's talk about some of the differences between the two, because I think it's easy when you're first getting started to get the two of them confused. Balance sheets are a constant measure of the business. The balance sheet begins when the business starts, and it's just an ongoing recording of the financial transactions within that business, and it ends when the business ends. And in between, it's a record of all of the financial transactions. Income statements, on the other hand, are annual measures of the profitability of the business. They track the annual revenue and gains from the business and the annual expenses and losses. So every year you do what's known as closing the books, and the profit or loss is recorded on the balance sheet as an increase or decrease in equity. And your income statement then goes back to zero at the beginning of each year. So balance sheets are just ongoing, eternally until the business ends. Income statements start at the beginning of the year and they end at the beginning of the year. And then you'll get a whole new income statement for the next year, which will start at zero and it'll track the income throughout that year and it'll end. And then you record that as equity or a loss of equity, and then you'll go on to the next year. So that's one key difference, is one is ongoing and one is annual. So with income statements, because they only go for a year, it's very important that the data be recorded as close to the point of the transaction as possible. And dates of transactions are really important. So was that income earned this year or was it earned last year? Was it earned in March or was it earned in September? Were the expenses incurred in July or were those expenses incurred in August? These are all very important in order to be able to, at any point in time, look at how the business is doing. So in the next few slides, we're going to talk about how to use some of this income statement data to assess the performance of your farm. So just remember that income statements are all about looking at profitability. And there's two key measures that you can get from income statements: the return on your assets and the return on your equity. Return on assets measures the profitability that you're generating per dollar of assets that you have. And it allows for comparison over different sized firms and different types of businesses. As the rate of the return on your assets rises, the more profitable your operation is. Return on equity is the return the owner of the business receives on the money that they've invested in that business. And you can compare return on equity compared to other rates of return for other very similar investment opportunities, such as stocks, bonds, savings account. So your return on equity should be higher than your return on assets. And as the rate of return on farm equity rises, the more profitable that farm operation is also. Financial efficiency is another metric that you can use balance sheet data for. Or income statement data for. Financial efficiency refers to how effectively a business or a farm is able to generate income. It looks at, if looking at financial efficiency, lets the owner determine how much different aspects of the business affect the gross income of the business. Is it getting the money from production? Is it getting the money from marketing? What kinds of things are adding to that value? So one metric that can be used is for financial efficiency is your operating expense ratio, and that shows the proportion of income that's being used to cover expenses, not including principal and interest of loans. And the lower the percentage, the better. So you've got total operating expenses, but you take out interest and depreciation divided by gross income, and that would give you that ratio. Another measure of financial efficiency, and I think this one is in some ways easier to grasp, is asset turnover rate. And that measures how efficiently a farm's capital is being used. So when you go out and you buy a big piece of capital equipment, how much are you actually utilizing it in the wealth that you're generating? And the higher the percentage, the stronger the business or farm. And so it would be the value of production divided by your average assets. And your value of production is your total revenues from production. And we can use these metrics to benchmark your business against other farm businesses, with the caveat that different types of farm businesses, crop farms versus livestock farms, early stage farms versus later stage farms, are going to have slightly different metrics. But in general, like a return on assets, profitability, a strong business would have greater than 5% return on assets. A stable one would have between 1 and 5, and a weak business would have less than 1% return on your assets. A return on equity should be more than that, and you'd compare it to investment. So if you can earn 8% investing in a mutual fund, then how does your farm's profitability compare to that? Asset turnover ratio. Greater than 45% would be strong, less than 30% would be weak, and then in between the two would be stable. And operating expense ratio, less than 65% is strong, 65 to 80% is stable, and greater than 80% would be a weak. So operating expense ratio means that if it's more than 80%, that means that you are using more than 80% of the money that you generate, your income, to cover your expenses. So it's costing you a lot of money to raise whatever it is that you do. One way of thinking about this is sometimes people will say, well, what's more profitable, tomatoes? I want to raise tomatoes because I see that they are $12 a pound. Well, how much do you have to spend to get that $12 a pound? Versus something that might be only $5 a pound, but you spend a fraction of that to get that $5 a pound. That would be operating expense ratio. Well, and I hope that information was helpful. In the next video, we're going to be talking more about budgeting. We're going to learn some techniques for using budgets to help manage your operation, and we're going to cover things like enterprise budgets, partial budgeting, and cash flow budgeting for your farm.